The rapid appreciation of the dollar against world currencies caused by the Fed's change in policy to fight inflation by raising interest rates has turned the dollar into an economic wrecking ball. All right, so in this video, we're going to talk about the rapid rise in the dollar's value and its effect on foreign governments, particularly developing nations. And we're also going to talk about the rapid devaluation of the pound. And I'm going to have some clips from Mohamed El-Erian on the subject. It's going to be very interesting, and it's going to help you to really understand how the strong dollar is affecting and in many cases destroying world economies. Okay, so the dollar's importance to the world's economy cannot be overstated. The dollar is considered the world's reserve currency. Now, what does this mean? What this means is that many transactions that occur throughout the world in the economy and by many countries around the world, these transactions have to be conducted in dollars. Okay, this is because the dollar is the world's reserve currency, or the standard by which the world transacts goods and services. A perfect example of this is oil and gas. If you are China, Venezuela, Italy, any country in the world, if you want to do a major transaction and go on the world market and buy oil or gas, you have to convert your currency into dollars. It's called petrodollars. All major transactions in the energy market are conducted in dollars. So what this means is if your currency has devalued tremendously against the dollar, you are going to have to put up more of your currency when you convert to dollars. Therefore, everything is more expensive. So as a result, the strong dollar contributes to inflation. For every country that has to convert their currency into dollars, oil and gas is more expensive. Virtually every good that you have to buy on the world market that is transacted in dollars becomes more expensive. And nowhere does this hurt an economy more than in the developing world. And the reason for this is because their currencies tend to be the weakest and they tend to depreciate the most against the dollar. In addition, most developing countries borrow money on the world markets denominated in dollars. Here's a look at the most indebted nations in Latin America and the Caribbean countries. You can see Brazil, Mexico, Colombia, Peru are among the most indebted. And many of these countries borrow in dollar-denominated securities. So when their currency devalues against the dollar, their debt automatically becomes much more expensive. This situation is not without precedent. In the late 70s, early 80s, there was something called the Latin debt crisis. And what this basically was record high inflation during the 80s caused by the Federal Reserve's effort to curb oil-based inflation. It was a little bit different. It wasn't based on the dollar appreciating because of just a rise in interest rates. It was a combination of a rise in interest rates and also a decline in oil prices. So these developing nations, many of them which were dependent on selling oil to pay their debt service, the oil prices went down, and at the same time interest rates went up and they got squeezed. In August 1982, the Mexican finance minister indicated that his nation could no longer make the interest payments. By the end of 1982, approximately 40 nations were in arrears in their interest payments, and a year later, 27 nations, including 4 major Latin American countries such as Mexico, Brazil, Venezuela, and Argentina, were in negotiations to restructure their existing loans. Now, back in those days, it was more of a banking crisis because a lot of this debt was lent to these countries by banks, but nevertheless, you had the same situation where you had rising interest rates, and at the same time, you had an increase in the value of the dollar, and you had, as I mentioned earlier, a decline in oil value. So they got hit with the triple whammy, and many of these countries defaulted. So fast forward to today, you're seeing a similar situation in literally every developing nation that has dollar-denominated debt. You're seeing their costs rising not only from everything because of inflation, and some of these developing countries are seeing inflation rates that are just unconscionable, 40%, etc. But you're also seeing all of their dollar-denominated debt just spiral out of control in terms of cost relative to their currency. One of the recent examples of this was the enormous devaluation recently of the pound relative to the dollar. Now, obviously, England is not a developing nation, but you can see how it's even affecting developed nations to the extent that they have to pay debt that's denominated in dollars and or just buy things on the open market due to inflation. The UK hit an all-time low against the dollar as the 2-year yield soars 55 basis points. The rapid depreciation in the pound can be seen in this chart where it hit the all-time record low just earlier this week. This resulted in a policy change that the UK implemented, some would argue, right at the wrong time. They stepped into the market, they started buying the gilt or pounds, and they did a market intervention, and at the same time they cut taxes. And so this combination of cutting taxes and providing liquidity to the market made a lot of people sit up and take notice, because it is really going against what literally every other central bank is doing in the world, which is raising rates and draining liquidity to try to quell inflation. Top economist and market strategist Mohamed El-Erian says the relentless appreciation of the dollar is terrible news for the global economy. And this is really the genesis to the title of this video, which is "The Dollar is the World Economic Wrecking Ball." Take a look at a couple of these clips of Mohamed El-Erian, and I'll come back with comments.
Mohamed, what is the perfect world? Is it a world where central banks are synchronized and they tell each other what they're ready to do? Do you think this was a surprise to the Fed here? And is it? I've seen two takes already on Twitter. One is finally someone's doing the responsible thing in terms of data dependency. And then I've seen another that said, well, now we know how firm their resolve was over in the UK. They have feet of clay. I mean, how do we view it long term? Do we want the world's central bankers synchronized in tightening to conquer inflation, or do we want people to go their own way based on their own currency or their own circumstances?
So first of all, this has nothing to do with data dependency. The data dependency today would have meant a more hawkish central bank, not a central bank that puts in liquidity. The numbers that came out this morning in the UK showed that prices at supermarkets, the inflation rate is going up. So this is not data dependency. Right. This is responding to the risk of market malfunction and real concern about financial accidents. This is what this is. Now, it goes counter to what they need to do for inflation. So it highlights the inconsistency of monetary policy. Look, Joe, you and I have always warned, the longer you stay in this la-la land of QE, flawed interest rates, dislocated markets, funny interventions, distorting asset allocation, the longer you stay in, the harder the exit. And what we are seeing is that the exit is really complicated.
Mohamed, I guess the data I was talking about was the pound and equity markets around the world. So that's more of a Fed put data, and obviously that's not what central bankers should respond to. But you see what I'm saying? I'm not talking about the inflation data. Yeah. I'm talking about the effects that the tightening is having. Do you think the Fed should take that into account with what's happening? 7% mortgage rates? I mean, maybe they need to look around.
Well, if they worried about mortgage rates, it's because they're worried about the impact on the real economy. What they cannot do because of inflation is provide an in-the-money put. They just cut. Those days are gone. I think all of us have to recognize that we are going through a major paradigm shift in financial conditions. Central banks have to step back. They overdid it. They were late in recognizing what they had triggered, and now they need to step back. The problem is stepping back is very risky. And the last thing the Fed wants is to find itself in this major inconsistency that the Bank of England now finds itself in. It was about to do QT. It announced that it would hike even more aggressively on November 3rd, and now it's injecting liquidity.
Can you walk us through one by one what you think needs to happen here imminently in the next few days, the next few weeks?
Yeah, and let's take the example of the UK because I think it's very illustrative. So, John, we knew that the exit from the paradigm of easy money was going to be hard. And we thought that the major challenge was going to be the balance between inflation and recession risk, as you heard in the tape. The question now is financial stability. That it turns out that there's also significant financial stability risk. And all it takes is some action, some unforeseen action. In the case of the UK, it was the fiscal action to trigger this financial stability concern. So suddenly, the Bank of England finds itself in the ECB situation, where it has to figure out how to use monetary policy to contain inflation, and then some other measure to contain financial risk. And then these two things are in conflict. So we've discovered that this is an even more complicated exit, and it doesn't help that central banks are late. So I just think we have to buckle our seatbelt even tighter. And we have to recognize that policymakers are no longer repressors of volatility, but they contribute to volatility. And that this journey is going to be incredibly bumpy. And hopefully the new destination is a better one because it's less distorted, but it's a very bumpy journey.
Yes, okay, so I think what he is really objecting to here is the inconsistency between what the British Central Bank was saying only a few weeks ago, where it was going to go through QT and actually tighten credit and continue to raise interest rates. What basically happened was they caved when they saw the degree to which their currency was getting crushed because of the strength of the dollar. And as a result of that, and as a result of them seeing their sovereign bonds getting crushed, they felt that they had to step in and provide liquidity to the market. That combined with a policy of cutting taxes, which is actually inflationary, just runs counter to everything that the central banks all around the world are doing. And I think what he's looking for is more consistency. But you can see the degree to which this strengthening in the dollar is even affecting nations like Great Britain. Okay, so where does this leave us? We all knew that when the United States Fed and the other central banks around the world committed to QT and raising interest rates, we all knew it was going to be painful. But what we're seeing right now in this new paradigm that went from incredibly tight monetary policy, printing money, keeping interest rates at zero, to now rising interest rates and declining liquidity, you're going to experience market dislocation in developing nations, and we're seeing also in the developed world. This is going to be a very painful process to unwind because it was completely manufactured by bad government policy all around the world and extremely bad Fed policy and central bank policy. And now all of these distortions and all of the bubbles, asset bubbles that were created in the world have to be corrected, and it's going to be very painful, and it's going to be very dislocating to markets around the world. All right, well, thank you for joining me for this video. If you got value out of this, please like and subscribe. I'd love to have you on board on the channel for future videos. We put out videos on the economy, on the markets, on specific stock recommendations, and it's all intended to make you a better and hopefully richer investor. Thanks again for watching, and I'll see you on the next video.